is the headline that's garnering all the attention today.
All the evidence shows there's an investment boom going on.
Markets are looking for clues about the health of the job market.
Artificial intelligence absolutely has already been a disrupting force.
People are right to question how much longer this bull market can run.
With stocks rising, fueled by big tech and easing trade tensions.
This week, the Fed voted to lower interest rates another quarter of a point.
Take a look at futures. Now a little bit of a mixed bag. We've actually seen the Dow tick lower.
Oh boy, here we go again.
It's time to tune out the noise and tune into great information with A Steward's View. Expect valuable economic updates, investing techniques, and planning concepts that will move you to be wise and decide well. You'll be equipped in a stewardship mindset, managing God's resources 1 week at a time. You can listen to this podcast and previous episodes at astewardsview.com. Now, here's your host, Aaron Kolkman.
Welcome back. I'm Aaron Kolkman. That's Chaz Louder, and this is A Steward's View. I'm so glad you joined us again. Please check out the economic and market roundup today at astewardsview.com/blog. Find all of last week's information, all the economics, all the investment insights, everything that you would need to make clear tactical decisions at, again, astewardsview.com/blog. Today on ASV, we'll take a look at war, the economic picture, and asset aggregation. In fact, Chaz, it'll be a throwback to our June 16th, 2025 episode under the same title. The mission here is to cut through the information chaos of the digital era so you can be wise and decide well. That is, we want to bring light to your financial decisions as stewards, you, your family, and your financial professionals. So before we get going, let's take a moment. Let's examine our work in the context of God's word about stewardship. And Chaz, being a pastor, I think you'll recognize this, the parable of the talents. I've got ESV as the version here, so more literal, but here it is. This is from the book of Matthew, I believe chapter 25. You could check me on that. 14 through 29 or 30. For it will be like a man going on a journey who called his servants and entrusted them his property. To one he gave 5 talents, to another 2, to another 1, to each according to his ability. Then he went away. He who had received the 5 talents went at once and traded with them, and he made 5 talents more. So also he who had the 2 talents made 2 talents more. But he who had received the 1 talent went and dug in the ground and hid his master's money. Now after a long time, the master of those servants came and settled accounts with them. And he who had received the 5 talents came forward, bringing 5 talents more, saying, Master, you delivered to me 5 talents. Here, I have made 5 more. His master said to him, Well done, good and faithful servant. You have been faithful over a little, I will set you over much. Enter into the joy of your master. And he also went, and he also, who had the 2 talents, came forward, saying, Master, you delivered to me 2 talents. Here, I have made 2 more. His master said to him, Well done, good and faithful servant. You have been faithful over a little, I will set you over much. Enter into the joy of your master. He also, who had received the 1 talent, came forward, saying, Master, I knew you to be a hard man, reaping where you did not sow, and gathering where you scattered no seed. So I was afraid, and I went and hid your talent in the ground. Here you have what is yours. But his master answered him, You wicked and slothful servant. You knew that I reap where I have not sown, and gather where I scattered no seed. Then you ought to have invested my money with the bankers, and at my coming I should have received that which was my own with interest. So take the talent from him and give it to him who has the 10 talents. For to everyone who has will more be given, and he will have abundance. But from the one who has not, even what he has will be taken away. So there's all kinds of great content there, Chaz, from that parable in Matthew that Jesus spoke. And, I think we could probably spend the rest of the week talking about it. I do want to point out a few just takeaways that I've looked at, and it has to do with stewardship over ownership, right? That's the first thing, and that's a core piece of what we do here at ASV. So we don't want our own talents, time, or resources. We don't own our own talents, time, or resources. We're stewards. We manage them on God's behalf. Okay. So the idea of productivity over passive retention, the idea that fear leads to failure. Individual accountability is important. God rewarding faithfulness. All of those things can be taken out of that short section of Matthew. Was I right? Is it chapter 25?
Yeah. Yep. 25.
Oh, good.
Starting at
Okay.
verse 14.
Cool. So yeah, just so much richness there that we could spend lots of time. But these verses fit with the major idea associated with a steward's view. That is, we are stewards or managers, not the ultimate owners of our financial picture, not the master of our own destiny, as is commonly thought. Our financial resources, then, we want our decisions to flow from that viewpoint. Okay, so before we get into this week's content, we'll take a quick break and check out our noise segment as well.
Investors have holdings scattered under multiple logins. Now there's one place to put it all together. Your entire portfolio in one place. Every asset house, every holding, every transaction, every day. It's called Fusion. Fusion means ongoing portfolio aggregation, without a contract and without a hitch. This important tool can put all your investments into a single view with a universal login, provided by Morningstar and sponsored by Fideer Advisors. Fusion gives its users the benefit of a constant monitor and quarterly risk-reward reports on the entire portfolio. So take a break and take advantage of this valuable view. Register now at FideerAdvice.com. Just click Fusion at the top of the page or type in FideerAdvice.com/Fusion. And now back to A Steward's View.
So, Chaz, I'm guessing that you have a really special noise segment today. It's been a little while since we've done this, and I know I talked to you this morning, and you said you were looking into it.
Yeah, I do. I've got something really, really great as we kind of get back into the swing of things. It's going to be the grab bag, Aaron. All short, all poignant, all, I would say, icons or captains of kind of the financial world, and you get to decide who you want to comment upon today. We got Robert Kiyosaki with a short thing about are stocks actually a smart investment? Okay, that's Robert. Then we've got Warren Buffett talking about advice on what to invest in. And I know that he's, finally retired, but he's talking about kind of what he would hold and what he would invest in. And then we got a short one from Dave Ramsey. It's the 4 types of funds that he invests in. So, which of the 3 would you like to go with today?
Okay, so, oh man, this is tough. I mean, you've got a book salesman, the most successful investor that's ever lived, or one of them, and then Dave Ramsey, who is the how-to guy. So, I'm going to go with Buffett because I like wisdom.
Okay, so this is it's a short one, and kind of this is like a personal reflection from him. I will pull that up, and you can just kind of give what you're thinking on that. Let's see here. 1 second. Actually, let me hit the screen, and here's Warren. 1 second. All right.
Given
here he goes.
Individual, particularly my wife, I just think that having a tiny fraction, which is all it takes for her to do very well for the rest of her life, I think that the best thing to do is buy 90% in an S&P 500 index fund. I think Berkshire is a very...
Okay, just a short little thing. The reason I picked that for you, Aaron, is because in the past when I've given you a clip, so many times you will say, oh, well, how old is this person? Or what's the context there? Or, that's good advice for somebody. And he goes, okay, I'm thinking of my wife and what she should do. And so he said, yeah, Berkshire is great, but I think you should put 90% in the S&P 500. What say you? What's your thoughts on that guy?
Well, that guy has wildly outperformed the S&P 500 over a long period of time. He's one of the few. And by the way, one of the reasons that he doesn't get viewed in the context of like fund managers and some of the big names that we talk about in mutual fund and ETF land is because he's not running a fund. He's running a conglomerate that operates in similar ways to a fund in the sense that it holds multiple other entities. Okay. And so you're buying all these other underlying companies and instead of the mutual fund format. Okay. It's just, they're subsidiaries. Okay. So having said that, I'm confused I think what he's saying is, by default, somebody that isn't interested in what I do should buy the S&P 500, but he didn't quite say it that way. So, you know, I'm interested in what he's done. A lot of other people are too. I don't know that. I'm a little confused about that commentary, to be honest with you. And here's the other thing: the S&P 500 is a great thermometer. Okay, and it's an efficient one. It tells us a lot of what's happening with stocks, and we know that stocks are a leading indicator of the economy, along with multiple other indicators. Okay, so what we don't know is, or maybe what we don't pay attention to. Let me say it that way: we know what the risk scores are, we know what the return scores are, but we talk about the return side, right? And so the biggest reason I have a job in the portfolio space anyway is the work I've done since 2006 at risk adjusted returns. Okay, so I'm going to pull up for us next week, Chaz, the Berkshire Hathaway standard deviation, right? And I could probably Google it right now, in fact, and get it for you. Let me see if I can get it quickly. But that is total risk. Okay, so he's talking about efficiency investing in the S&P 500 by default. That is exactly the return and exactly the risk of the marketplace, nothing more, nothing less. Okay, so if you have somebody that's outperformed that much, let me type in brk.a, so A shares standard deviation. Let's just see what that is. The S&P 500 is about 15. Yep, it's about 15. Okay, so that just means that if the return has been, let me look at the historical return. Return has been, I'm not going to get a rolling probably. 19.8% from 1965 to 2023, far outpacing the S&P 500, which has been 10% over the same time period. Okay, so, and I'm rounding, but that, it tells us a lot, doesn't it? So he has the return, almost doubled, and the risk score managed to the same point that the S&P 500 is at. Incredible. It's amazing. There's a reason he is where he is. So I could go further into value investing and why I think his approach and his mindset and his process and all the things have been so wildly successful. I'm still confused by the commentary. So that's what I have as far as how I would add to what he said. Put it that way. And there's very little you can take away from Warren. Okay, I would add that any kind of risk adjustment you can get in what you're doing is an excellent idea, right? However you get it, right? And so he's been getting it in the sense that he's matching up on risk. We just said that, and increasing in return in a big way, historically speaking. Let's just keep focused on risk also when we talk about major indexes, because major indexes don't do risk improvement. They don't do return improvement, right? And so you can't get a consistency deal, as I call it, a tighter range of returns around an average that you need to fund your goals if you're just buying the index. However, highly efficient indexes like the S&P 500 are very, very good as a default. So I agree with him. That's the long version. I would love to hear more of that commentary if there's, part 2 or 3 sometime in the near future.
There we go. That's what I got. Right. We'll save Dave and Robert for another time.
Yeah. Okay. Yeah. Dave, and I don't mean to say they're not wise, by the way. Those are, I don't know them. I just know that the wisest to the 3 is the one that's, I'm choosing by virtue of earthly success. I have no idea what his other forms of wisdom are. Okay. So as far as the core content for today, are we kind of caught up now? Let me get back to the ranch here, so to speak.
I think we're great.
So, thank you for that. It was just delightful. So let's talk a little bit about what's happening geopolitically. Let's talk about the economic outlook. Let's talk about asset aggregation. Okay. So then you can decide, what noise you listen to later, or you can just not listen to it, as I often say. The war in Iran, in short, the market needed a reason to correct. If you listen to late 2025 episodes, even the very beginning of this year. We took a couple of months and hit pause to serve clients that we work hard for during the tax season. And we're back now, and there's this war going on. Okay, it's real. Asset prices are fluctuating. There's extra volatility. What happens with inflation and then interest rates is incredibly important. And so we have to say, okay, is this a long-term thing or a short-term thing? That's the big question on a lot of investors' minds. And I didn't say trading types. I said investors, right? Because we've had some bounces with the institutional trading types during a correction that we're getting. And I'm using the word correction loosely here. Okay, we're not quite into correction territory, but we're very close. We're off about 5% in the major indexes so far this year. All right. By the way, the rolling S&P 500 1-year number is about 15% still. Right? That doesn't get talked about. Oh, everything's down. Okay. Yep. Nope. Everything's up. Oh, what time period? Okay. So we just need to keep in mind that this was a correction that or a correcting behavior that we needed to have because asset prices were getting high. PE ratios were soaring. Forward PEs were a little bit better, but not a lot. And now we have the market telling us that it's going where it wants to go. Right. And yes, the headline, yes, the war, yes, oil prices, yes, all of that. How can we think about it, though, especially if it's just short term? Well, what we do is we take a look at the big picture. We zoom out and we say, all right, well, what are the economic truths going on? And then how can we view what we have going on as investors, right? So those would be the couple things I want to touch on in this episode. As far as the major things, I pulled up an article I'll post tonight from Barron's that I thought was really good, and it's written by Jack Hugh or Howe, Hough. He says the stock market is more expensive than it looks. Tread carefully, right? So that's kind of going with what I just said in terms of the idea that we're not in a full correction, right? To be clear, but we're getting to that point, and we haven't had one since the bear market of 2022. So, we went 3 full years with major run-ups in stock prices, moderating, slightly decreasing interest rates, and a resilient job market. Let me see if I can get this to come up here. So the comment would be just, let's wait and see, but don't be surprised if we have a little bit more downside. The bump we got last week was very quick, very institutional, not a real bounce, if you will, the way it turned out, because we've had more downside pressure, just today, even in parts of last week. So as far as what to expect the rest of the year, I do want to say real quick, I don't, if we hit long-term averages on the S&P 500, I'll be thrilled. That just means a 10% annual return in the year 2026. I personally don't think we'll get there. I also don't think we'll be in recession. All right. So I think we'll be somewhere in between. I think we'll have kind of a malaise year on paper. And then we'll see some regrowth in asset prices in years ahead. So I don't have a lot to react to as far as what I'm seeing, but I do want to mention a couple of other articles I pulled up that relate to economics as I am trying to get us to hear more in terms of mindset. Article in Bloomberg, the Barron's one, I just got kicked out, so I got to keep going here, Chaz. I even paid the bill, so who knows? Let's just see. The Barron's thing, yep, that's gone. Bloomberg, here we go. This was yesterday. U.S. jobs gain of 178,000 tops forecasts and unemployment falls. So written by Mark Niket. Actually, April 3rd. That would have been Friday. Sorry, it wasn't written on Easter Sunday. So we had this rebound in March, and this would have predated. It's a look back. Non-farm payrolls went up 178,000 last month. Okay, so what I'm trying to say is that was prior to the Iran conflict. All right, so economists had expected a bounce back in employment in March after a strike by more than 30,000 healthcare workers and severe weather contributed to outsized decline in February, quote unquote. So this solid increase will more than likely have the Fed's focus on inflation, okay, which, naturally they would, given we have a ramp up in energy prices going on. Yes, the Strait of Hormuz, I think is how you say it, is still closed. And that's a third point I wanted to get to, then maybe the most salient of the three. And here it is with Barron's again. We'll see if they'll let me in. Okay. This was Jamie Dimon talking about skunks. So maybe we can get that on the noise segment coming up here, Chaz, next week. But he was here. I'm just getting a boot real quick. 1 second. Yeah. So the article says Jamie Dimon has moved on from cockroaches. All right. Why a skunk at the party is his new concern. Right. So we're quoting the CEO of JP Morgan, the 20+ year wildly successful CEO, billionaire Jamie Dimon. The article itself is written by George Glover, and basically Glover is honing in on Dimon's what I think of as a consensus opinion in most anything he says, right? And this is his annual letter to shareholders. It was 49 pages long, just came out. And let's see. He said, interest rates are like gravity to almost all asset prices. And falling asset prices at one point can change sentiment rapidly and cause a flight to cash. Okay. So that's kind of the backdrop or the why. But the quote is, that was a quote, but the key quote is, skunk at the party, and it could happen this year, would be what? Inflation slowly going up as opposed to slowly going down. This alone could cause interest rates to rise and asset prices to drop. Okay. So we already have asset prices dropping, right? We have the S&P 500 correcting. We have oil prices dropping, right? So, rising. I've been saying that backwards. The point is, we've got this shift going on because this war is going on because asset prices wanted to correct it on the stock side, and on the oil side, the energy costs that are rising can cause inflation. And if inflation happens and the Fed says, oh, wait, there's too much inflation, we could have interest rates go up, right? That's the Fed response to those situations. And so what happens when interest rates go up? Asset prices drop. So I'm not a bear here, but I am thinking that we have a very short-term tenuous situation that's exactly what Dimon's talking about, and that is to say, if energy prices stay high or rise even more, we have a difficult time imagining inflation dropping, right? So if inflation is rising even gradually, stocks don't like that, and we could be in for a longer-term economic response, even if we have energy prices come back down at some point. So,
Aaron, I got you that video. I think I got 60 seconds with Jamie Dimon doing that exact thing.
Let's hear it.
Let me just back it up here.
How offsides would this market be if there were truly a stagflationary shock, given the fact that there seems to be comfort with the idea of disinflation right now?
Well, I think that's true, but I think that was true before this war. So if you look at, my view is that the asset price is kind of high, credit spreads are kind of low. There's kind of a lot of complacency in the market. I'm not sure. We look at risk. We look at the broad range of outcomes, and there are negative outcomes. But one of them would be, inflation. I call that's the skunk at the party. So it's been coming down, but it seems to maybe leveled off around 3%. If things make it go up, and this is only one thing. You can look at medical prices, construction prices, insurance prices, wages for certain things, other things. Inflation is a big thing. It's not just oil. So we'll see. Right now, this will add a little bit, literally a teeny bit to inflation, not a lot.
Yeah. So exactly. And if I said earlier, by the way, that I'm trying to navigate two different narratives here, and the one is that stocks have been correcting, right, and they needed a reason to correct, whatever the reason, right, and they got one in the Iran conflict. On the other hand, the Iran conflict has helped push energy prices higher, not lower, and so we have this inverse relationship between those two. But interest rates are at least in the U.S. are based on two things, right? They're based on employment and they're based on inflation. So if either one of those two things is weak, then we have let's see, if employment is weak, okay, that's a reason that interest rates might adjust. If inflation is weak, that's a reason that interest rates might adjust, or both. So what he's saying is that if we have enough price inflation in energy, oil in particular, then we could be in for higher interest rates, which would be a natural Fed response. And that, well, we already have correcting stocks, can bring asset prices even lower, right? So, Chaz, we may have to go back and edit some of what I said earlier, FYI. But the point is, this is a tenuous situation, right? And he's not adding that because I'm sure he doesn't want to stoke any fears. Neither do I. But even if the Iran situation is resolved in the short term, the long-term economic response can be played out the rest of this year, right? So if in a month from now we have nothing going on in Iran, we could be looking at, third or fourth quarter until we get back to some kind of normal, if there is such a thing anymore. So I'm not losing any sleep, but I'm definitely watching this inverse relationship between stocks and energy prices, and I'm very interested in the Fed's narrative in the next couple of meetings. So those are the thoughts I have around those comments from Jamie. As far as how investors can position things, what I want to do is say, make sure that you've got a handle on the big picture, okay? Because when you've built a portfolio, and one of the things I actually really liked as I look back at Warren Buffett's comments there from our noise segment is when you've got a very small number of stocks like Berkshire has as subsidiaries, you have a concentrated portfolio that's much more responsive to the environment. Okay, now he's chosen conservative positions, his team has, his new CEO and so on, but nonetheless, it's still a concentrated portfolio. Okay, the S&P 500 is broader. Okay, well, what's broader than that? The global marketplace is broader. And how else can we manage risk? How can we get below a 15-point risk score or standard deviation? Well, we could add some fixed income, right? Is that right for your portfolio? Maybe. How about, we talk about commercial real estate. How about foreign stocks? How about foreign bonds? How about emerging market stocks? How about gold? How about other commodities? How about some hedge positions? Right? And so those are conversations that I like to have when we're looking at these things. And the best way you can do that conversation, I would actually encourage you to not listen to any one podcast anywhere and sign up for anything. Right. And it's the reason that we do aggregation every day. And Chaz, I want to make a quick mention. I don't make many plugs for our sponsor firm. The firm that I operate called Fidir Advisors in Minneapolis. So we just upgraded our system. We ended that major upgrade, biggest one I've gone through in 15 years, that ended March 31st. And we've got a new method now under our Fusion program. So anybody that wants to visit fidiradvice.com/fusion, FUSION, fidiradvice.com/fusion. And we'll put that up tonight as well. But that program, once you register for it, there's no advisory contract, there's no fee, there's no obligation, right? You just have a feed of any invested asset coming into one place, and it's this ongoing second opinion with what? With quarterly reports and commentary from me and others that here at Fidir that will help you with this exact conversation. Okay. So you're highly concentrated, or you're this, or you're that. What's your risk profile, right? What asset classes are you in anyway, right? Do you have any exposure to oil? Does it matter, right? And by the way, what's the overall risk profile of your entire portfolio? Okay, and how does that interact with the return that you've been getting? Right. So that Sharpe ratio, that 3 or 5 year Sharpe ratio on an aggregate portfolio is impossible to get if you don't aggregate. So we can get a perspective from that helps us stay zoomed out. Right. When the worst is happening, we can just kind of turn it off and, hopefully not binge watch TV and go outside or play a game or do something. But, I want to encourage this aggregation because it gives us that big picture view, and it's very, very missing. Last thing I'll say about it, I had a Friday night conversation April 3rd, so last week, with a friend of mine that was saying, well, what if I've already got that done, right? What if I've already kind of pulled everything together? Okay, awesome. Then we get to do a comparison. I call it kind of a double comparison. You can then take your overall, and you can say, where in the world am I invested? and we can find a benchmark that's appropriate for it, right? Hopefully it's global, but we'll match up a benchmark. What is that? That's a marketplace, kind of default that we can compare to. And then we'll look at an optimized model. And what does that mean? An optimized model just means that we've worked at looking back with historical return and risk data at where in the world to invest and what managers have managed risk better than their peers and better than their areas of the market. Okay, so that model and that blend of managers, you can find examples at fideradvice.com/models. But that second comparison, along with the scoring that I've talked so much about on this program, will give us a very good idea of, do I have an allocation premium or don't I? Right? Should I be indexing like Warren Buffett said, or shouldn't I? Right? Should I be doing something to adjust what? Not should I hold more or less oil in my portfolio or more gold or more whatever, but who am I as an investor? How am I actually invested? And what is it I can do with the happiness of those holdings together to optimize my risk and return? And yes, I can measure it. So that's also on our website. So I really think that there's a lot here for any situation, right? Particularly when you're talking about big life decisions coming up. I helped somebody retire a week and a half ago who's an accredited investor and a relatively new client at our firm. And this piece of it was more critical to he and his wife than anything else that we did, right? And that's a repeated theme in the 25 years I've done this work. So I hope that I've given ample encouragement here, that opportunity is there. The software and the platform, Chaz, is what I'm trying to say, just got massively upgraded. We now have an app. Sorry, I almost forgot to say. On the app, once you're on our system, we'll give you a login, and you can just pull up the app without an advisory contract, and you can sit there and add accounts and pull all your stuff into one view, and you can look at it right from your phone if you want to. So I used to discourage that stuff because it was this, overwhelming, perhaps trading mindset that we were breeding. But in this day and age, we're in the digital era. We got to know what we have. There's a lot of stuff going on around us and a lot of confusing messages. So let's get to that technical big picture and go from there. So those are my thoughts on what we have right now. I do want to touch on the weeks ahead here. We're going to go into a series. Chaz, am I going too fast?
No, man, this is great.
Okay, great. We're going to get into a series here in the next few weeks that is less about economics and investing and more about planning. But I want to talk about it as advanced planning because it is, as well as the heart of it. Okay, and so I'll just loosely call the series The Art and Science of Giving. We'll have Paul Larson come back, and today is April 6th, so we're talking about the 13th, the 20th, and the 27th of April. We're going to dive into the art and science of giving, and Paul has a rich background in theology. He's a biblically wise guy and a very interesting theologian to talk to, so we'll have him join us. And we'll go. He'll get more, I suspect, into the heart and the art of giving, and I'll give us some things that we can do with our estate plans, with our tax plans, both income and estate tax. So it's going to be a lot of good information that is again high level, big picture, strategic decision points that we want to cater to in this program. So I'm really looking forward to that. Today was just kind of a catch up, if you will, from the last couple of months and some extra commentary that I've saved. But we've covered a lot of ground. This has been a joy, and I just hope this session has been a blessing to you and others that you share it with. From here, all of us at ASV, we look forward to what's ahead. The remainder of April, I just mentioned. And so until then, let's just regroup. Let's gather up at astewardsview.com. And please do be wise and decide well.
You've been listening to A Steward's View. To learn more about Fidere Advisors or speak with Aaron, visit fidereadvice.com. That's FIDERE advice.com. To listen to this and other episodes of A Steward's View, visit astewardsview.com. A Steward's View is brought to you by Fidere Advisors, a registered investment advisor offering financial planning and asset aggregation. Asset aggregation systems are designed to align portfolios across accounts into a single, globally optimized investment plan for families it serves. Fidere maintains liquidity of client capital at major custodians and utilizes asset managers that have shown consistent historical performance through excellent risk management. This program is not an offer to transact any securities and does not constitute a financial planning engagement. Information provided has been prepared from sources believed to be reliable, but is not guaranteed and does not represent all available data necessary for making financial decisions, and is for informational purposes only. Fidare and its representatives do not offer tax or legal advice through Fidare. Please consult the appropriate advisor. Fidare Advisors LLC is a registered investment advisor. To discuss your situation or to learn more about Fidare, please visit fidareadvice.com. That's FIDERE advice.com.